Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I'm going to talk about a REIT. I'm going to talk about a real estate investment trust. This is one of the companies that I've had on my radar for a very long time. But obviously, this is one of the, when it comes to the REITs, they have a lot of debt. And for that reason, if the price of the stock goes down, which means then the debt levels and the base of the ratio then becomes a little bit funny, so it might go over the 33%, which we basically consider to be a Shariah compliant. Okay, and for that reason, this company, I have not spoken about it for a long time. So what I want to do today is I want to go over the financials. So I'm going to talk about first the business model, I'm going to talk about the revenue, I'm going to talk about the dividends, I'm going to talk about valuations, and then I'm going to give you my opinion of what I'm going to do with this company, whether it is a good fit for my portfolio or not. So that is what I'm going to do. But before we do that, before I mention the company, if you haven't joined us on the Discord or you haven't joined us on the Patreon, please do so, because it does help the channel. Okay, and inshallah, what we're trying to do as a bonus is to build a private Discord access. So inshallah, to build a private Discord where basically brothers and sisters can share a good practice, inshallah. Okay, so that's the plan, inshallah. If you can help us, that will be absolutely amazing. Right, the company that we're talking about today, or the stock that we're talking about today, is Prologis. This is one of the industrial REITs. Okay, Prologis is the biggest logistical real estate investment trust, or REIT, in the United States. It's known for having a massive logistics facilities in some of the best locations in the world, and mainly in the United States. So if you ever drive around either in the US or other places, you probably will come across one of those massive warehouses this company owns. Okay, and some of the companies that actually hire this include these companies. So if you look at this, okay, so UPS, for example, DHL, Expo Logistics, okay, the Amazons, the Walmarts and Sainsbury's, Home Depot, the BMW, PepsiCo, 3M, Samsung, you name it, FedEx, they all basically rent from this company. Okay, especially what this company is actually very well known. Basically, it's called the landlord of Amazon. Okay, Amazon has millions of warehouses around the world, and this is all of these basically warehouses this company owns. Is basically majority of them are rented to, not majority of them, a lot of them are rented to Amazon. So whenever you order something, most likely they will be delivered from a property that's owned by Prologis. Okay, so what do? They actually build the place, they have it, everything the company needs, and they just rent it out. So they collect rent every single month. Can you imagine having Amazon as your basically tenant? Every single month, you know you're going to get paid, regardless of whatever happens. And looking at this, well, actually, it's quite funny. 2.7 trillion in the dollars, by the way, in the economics value of goods flowing through our distribution centers each year. It represents 4% of GPD for the 19 countries where they do business. Okay, 2.8 of the world's GPD. Okay, GDP. And 1.1 million employees under Prologis roofs. So it's not a small company. It's probably one of the best industrial REITs out there. So what I'm going to do now is I'm going to go over some of the numbers, just basically to see if this company is a buy. So now you have an idea of what the company does and so on, and the fact that they own a lot of the warehouses that are rented by these companies. We now need to see if this company is actually a good business. Okay. So I'm looking at the year-to-date chart. You can see the stock is actually up, but almost 10%. So considering the S&P 500 basically is not even up that much, it's actually done really well. Okay, and for the 5 years, okay, you can see if you own this stock for last 5 years, you would have made 90% on your money. For the 10 years, 205. Okay, and just in a year-to-date is 9%. 6% for 6 months, and the 1 month is actually just flat, and the last 5 days is up about 1.5. I think today is basically down a little bit. Now looking at this side here, okay, the FFO, which is basically funds from operations forward, okay, this is equivalent of the EPS. So you can see they make $5.50. Okay, price to FFO, okay, price to fund from operations, which is equivalent of PE. So when you're talking about REITs, you don't use PE, okay, you use price to funds from operations. That is almost now 23. So it's almost like trading 23 PE, which is quite high. The dividend yield for this company, the forward dividend yield that is 2.8, and the market cap is $116 billion. So it's not a small company, okay? And the dividend yield is actually, for a REIT, is not that huge, but they are growing their dividends, and I will show you that in a second. But let's have a look at the revenue side of it, because that's the next thing we need to look at. As you can see, from 2018 they were making about $3 billion to right now expected in 2023 about $6 billion. So they're doubling it in about 7 years, okay? And then 2024 is expected $7.5 billion. So in a space of about 7 years, they doubled their basically that revenue, which is really good for this type of business. Now looking at their, if we take out the estimate, you can see the FFO, funds from operations, which is again like similar to the EPS, as you can see, from $3 to right now $5.16, okay? And if we include the estimates, you can see it's expected to basically earn more in the next few years, which is really good for the business. Now we're going to look at the valuations, and we're going to start with Morningstar valuations, okay? So according to Morningstar, it's 3 stars right now. Okay, it's flat right now, so they're expecting the price to be $124 per share. It's just below, just because of today is actually just below that, but it is flat, $124 per share. The company doesn't have any moat at all, because remember, this is easy to build this kind of warehouses. If you got enough money, if you're rich out there, and you're or even Amazon might decide, you know what, we're not going to pay you anymore, we're going to build our own. Obviously they buy the land and build their own basically warehouses. That's all they need, okay? It's stuff that inside the warehouses obviously the company owns and all of that stuff, but it's stuff that you can either rent or do it. So it's easier to get into this kind of business. For that reason, it doesn't have basically economic mode at all. And a lot of the REITs you will see actually do not have a economic mode higher than none. So you wouldn't see a wide mode or narrow mode for this type of companies. Now looking at the dividends, and we are now looking at we're looking at the Simply Safe dividend. So in terms of dividend safety, is 61%. So anything above 61% is actually quite good. And as you can see here, 2.83 is a current dividend yield. As you can see, the market cap, $115 billion market cap. Beta, I don't trust Simply Safe dividend beta, but I think this might be right, because this company is actually fluctuates a lot. So beta below 1 is what we're looking for. Above 1, that means it can be a little bit volatile at times. In terms of payout ratio, okay, basically it's edging higher for the industrial REITs. Basically that's what they're saying at the moment. But REITs are normally well known for to have a higher payout ratio anyway. 67% is basically where it is right now, and they have increased that dividends, okay, without reduction. Basically they have been paying it without reduction, but they haven't increased it for that long, and I'll show you how long they've been increasing this dividend. So the latest increase was 10%. So this is what attracts me to this business. I'm like, okay, that's really interesting for REIT, right? Last 5 years they've actually increased it for 12%, which is really good. Now you can see 2004 they were paying almost $3 and went up all the way to 4.5, and then they had to cut it down in 2018 because 2004 to 2008 it was perfect. 2008 obviously because of the situation that we were in at the time, especially with the housing situation. 2008, that's when they cut the dividend, and then since then they have slowly been increasing, which is good. So 9 years of increasing that dividend without actually increasing it every single year. So they let alone cutting it, they have increased every single year since 2018, which is really nice. They pay you quarterly, so these are the months that they pay, and as you can see, annual payouts $3.48, which is quite good. So the ex-dividend, so the last day you can buy the stock to earn this much, okay, is June 15. So you've got a little bit more time. And as you can see, from September 28, 2020 up until now, they have been increasing that dividend. So there will have not been any cuts whatsoever, and it has been going up. Now I'm going to show you one more thing. And this is one of the negatives about this company. So shares outstanding, as you can see, they have increased their shares outstanding every single year in the last 10 years or so. And the reason they have increased this is because they recently bought, let me show you quickly, a company called Duke Realty. Okay, so this were one of the main competitors they had. They spent about $23 billion to actually acquire that company. So that's probably one of the reasons why this has been happening for a while. Okay, maybe they made other acquisitions basically in the last few years as well. That's probably why. But shares outstanding is actually heading the right direction. But because this company is still growing, maybe they're using that money to build more warehouses so they can increase their total sales. But beauty is, although this has been increasing, which is a little bit of a negative, well, it's a bit negative obviously, but they have been increasing their total sales in the last 10 years, which is really nice to see. And obviously return on equity is kind of been fluctuating here and there. Return on invested capital is also heading the right direction. I mean, it has come down a little bit into 2020 and 2023. Basically, hopefully we'll see that coming back up again. Now looking at the earnings side of things. So we're looking at the consensus FFO estimates first. And as you can see here, year on year growth, about 6% expected, I think, this year, 2023. 2024, a little bit of decline. Then 2025 is actually coming back up. And I'm only going to use the first three because these are where a lot of the analysts are looking at the company. But there are three people looking at again in 2026. And they are also saying basically it's going to be a little bit decline. Then the following year is okay. Then it's okay. And so I'm not going to use those three. Okay, I'm only going to use the top three here, and as you can see, 6% is actually quite good. Okay, and then 2.5, and then 15%. If any of these come through, okay, on average, if you can make about 7% or more, that's absolutely fine. Now looking at the revenue side of things, from $6 billion to $7 billion to $8 billion to $8.8 billion. And again, I'm going to use the first three as usual. Okay, so up to 2025, you can see it is actually heading the right direction. And this is what you want to see. Okay, if this basically is the head in the right direction, the company is actually, the revenue is okay, the EPS is okay, or the FFO in this situation, then you have absolutely nothing to worry about. But again, these are analysts. Okay, they could be wrong, and that's why it's basically estimates. Okay, so you have to be careful with these things. Now we're going to look at the valuations company. So we looked at the business side of it, we look at the revenue, we looked at the dividends. Now we look at the valuations of this business. Okay, and that is where we're starting with ratings from Seeking Alpha. As you can see here, their software that they use was called Quant. Basically is right now it's a hold 3.27. In terms of the Seeking Alpha analyst, basically they saying it's actually a buy 3.62, and according to Wall Street is a buy 4.3. So Wall Street, as you can see here, is a little bit bullish on this company, and as you can see here, 14 of them has actually said is a strong buy, 6 said is a buy, 5 said is basically is hold. Whereas in comparison to this, okay, you can see there were 5 buys, 3 holds, and so on. Whereas this one doesn't actually give us anything like that. So if we go back to Wall Street, you can see their price expectations for this company is about $144 per share. That's about 17% upside from here onwards. We already looked at Seeking Morningstar, and that is basically flat right now. So where it is right now is basically where they're saying is the fair price. So it seems actually not cheap, but it's just fairly valued at the moment according to them. Now according to Simply Wall Street, it's overvalued by 13%, so they expected the price to be $109 per share. Okay, and 124 is where it is right now, and their future growth expectations for the company is about 12. So the earnings, they're expecting the earnings to grow basically about 12%. Okay, earnings growth rate and EPS growth rate of about also 13%. So not bad at all. And when you look at the tip rank, for example, they're saying it is definitely strong buy because they have 16 people that said it's a buy, 2 that's hold, and $142 per share is where they're expecting. That's about 16% upside from where it is now. That's very similar to where Seeking Alpha is also saying. Now, so that is the company. In my opinion, I only have one REIT company, so I have Public Storage. Again, they both companies are in the same sort of industry, so they are both industrials, and I really like both of them. Okay, so what I'm gonna do is, with the current price, okay, I think I would love the company to come down a little bit. Okay, maybe in 110 or so on, whatever. So let me show you what I will do to this company. So I'm gonna add it to my watch list. So this is the watch list that you can get access to if you sign up with the Patreon account, and you've got all the spreadsheets in there. So it will generate all this data for me first. Okay, and 124 is what Morningstar said. So I do like Morningstar quite valuation, so I'm gonna go with that for now. And then 124, if it comes down a little bit, I might actually start nibbling a little bit, but right now 124 is where it is. So if I let that go, you can see here, okay, the margin of safety, which is really important for every investor out there. Although they saying it's basically this is where it should be, you need to have your margin of safety. So I gave myself about 5%. So the formula there you can see is about 5%. Okay, so that 5% is very important to me, because that is my margin of safety. If you like, if something happens, at least I've got that 5% cushion. So 117 basically is where the price should be, and right now you can see 120, so not much, to be honest with you. So there's another $5-6. So would this company come down maybe $5-6? I don't know what's going to happen, but I am willing to wait, and that's the most important thing. And this is what I do with a lot of the companies that I own in my portfolio. When they hit my buy targets, then that's when I start buying a little bit, and so on. And you have to have this type of discipline, because it is, to be, in the end of the day, your money, and you don't want to waste it, right? So you want to buy companies, quality companies, that are obviously cheap at the time when you're buying it, because you never know what's going to happen in this market. Okay, so that's what I'm going to do with this company. So right now I'm going to show you, just to be transparent, I've got $230, pounds, or so whatever. I like to show you guys this because I found it basically I find it easier to, like, obviously to listen to someone when they actually put in money into the stock market, while I can actually see it. You know what I mean? I just like to show you guys what I'm doing. It's not to show off. Okay, so what I'm gonna do right now, I'm gonna buy a little bit of basically UPS, because that is my plan for the day. 1.3, I'm gonna round it up this to 25 shares of this great company. I believe they're still undervalued, so I would like to own maybe about 30-35 shares of this company. So I'm gonna do that, send it to the market. Okay, just to be transparent, to show you guys what I'm doing. I'm basically putting into the stock market every single day, and as you can see here right now, I've got 52 pounds. Okay, and now I have 25 shares of UPS. I'm going to stop the video there. I hope you have a wonderful day. Assalamu Alaikum.